All right, we'll go ahead and get started. First, I just want to thank Charles River, CFO, for coming online and doing a presentation for us today on navigating financial challenges in credit unions. So we have two really great reps from Charles River, CFO. We have Tim Smith, he's their credit union practice leader, and we have Martha Stone Martin, she's the VP of Marketing and Administration. So I'll kick it over to you guys. Go ahead and thank you so much.
Thank you, Amy. I appreciate the opportunity. Before I turn it over to Tim, who will be our primary speaker today, introduce Charles River, CFO, to you. Many of you probably heard of this webinar through your membership in CCUA, and I just want to take a moment. We are a boutique professional services firm that works with credit unions, community banks, nonprofits, tech, etc. Firms that need fractional or interim accounting or CFO advisory services. Typically, our clients come to us during a period of growth or transition when they're looking to get some additional resources, perhaps on an interim basis as they take the time to look for their next CFO or controller, or perhaps it's just an extra set of hands to get the call report done because somebody just walked out the door. So we've been working in this space, providing services for over 20 years. We're based in the Boston area, but work with clients across the country. As a matter of fact, two of our clients in the credit union space that we'll tell stories about later on are actually one's in Colorado and one's out in Texas. So we work with clients in across the country. Let me introduce Tim a little bit more. He's the credit union practice leader. Tim has over 25 years of experience providing CFO services as a credit union CFO. He has extensive expertise in scenario planning, modeling, building great teams, and comes to Charles River with that breadth of experience and now works with our clients. So I'm going to turn it over to Tim.
Thank you, Martha, and thank you, CCUA, for having us today. So the story today is going to be about three of the challenges that I think are out there today. Not that there's only three. There's probably there's a number of financial challenges today. Luckily for us, it's not the kind that you've seen in disruptions in like Blockbuster or Polaroid or Uber or something like that. So at least not yet. I mean, there's always things going on that could be more disruptive to our industry too. And kind of the one that I use periodically is Amazon Prime FCU. So Prime, Amazon Prime, Federal Credit Union. Imagine how that would disrupt our industry if they decided, like they've decided to go into other businesses, they decided to go into our business. So anyway, so the first challenge we're going to talk about is funding growth. And I think we can all agree that growth is required. Certainly growth in revenue, if not assets. But since most of credit unions' revenue comes from interest earned on assets, then so you see where you go with the asset being a big piece of growth, and then how do we fund it? So funding growth is a delicate balance, let's call it. I've got types of different funding up here. Probably none of that is different than what you know and understand. I put member loan payments in there also, because sometimes when people are planning, they kind of forget that the portfolio throws off more cash. The loan portfolio usually throws off more cash than anything else. I mean, the cash flows and deposits. There's a lot of churn in that, but it's typically pretty stable, or with small changes up and down. So when we talk about funding growth, we talk about funding growth in assets, in loans or securities or liquidity, and where do we get it from? So wholesale funding. is one that's on there also. When I say wholesale funding, I'm talking about either non-member deposits, which are typically institutional, other credit unions or other institutions, FHLB, which some or all of you may have that, be a member of that. If you're not, you probably should be. So we can talk about that at some point. Or the Fed or a corporate are the wholesale pieces. CDs have been a big source of funding lately, and the rate wars have been raging, and so we've had a shift from the non-maturity deposits into CDs, which is been one of the balances that we have to manage. But I don't want to spend a lot of time on this. But the question on the bottom is kind of a rhetorical question. How much funding is enough? I would say, and you may agree, that there's probably never enough funding. The only case where you have too much funding is when you don't have enough capital for all your funding, but that can be managed too. Capital is always king. Don't forget that one. All right, let's go to the next page. So what are the key drivers of funding growth? So we named what they are. You might be surprised by some of the things on this list, because higher rates is only the third on the list, and it may not be even, if I listed these in order of importance, may not be the most important. So certainly in the short term, if you need funds quickly, you can raise rates and you can attract some new deposits. But everybody else is doing the same thing at the same time. So even that has been very competitive of late. Things that are more long-term and strategic are, the things like brand, marketing, technology, cash management tools, et cetera, that have a longer-term lasting effect, particularly on non-maturity deposits. I mean, when you look at the folks that really don't have any problem in increasing deposits, and they're typically larger institutions that have significant budgets for marketing, that have spent well on technology. Think, I don't know, Bank of America, just to throw a big one out there. They don't have any problems with funding, and as a result, they pay very low rates most of the time, and we treat our members better by paying them better rates. But that's one of the things that you can improve on. And we could talk about all the credit unions that have done a great job in branding. I mean, take Navy. I mean, they have a big budget too, but they've done a great job on branding. But even you look at locally in the greater Boston area, which is where we're at, DCU's done a great job. So they're, but I just throw that out there because they're the biggest in the state. But you go to other states and you see some of the other institutions that have done great. Or if you go into individual markets, you may have a great brand name in an individual market, a town or a county that drives your growth better than anything else. And economic growth, which you probably don't think about when you talk about funding growth, but if the economy continues to grow, or the government, in the case in the last 3 or 4 years, keeps throwing money into the economy, that drives deposits up too. So I got a couple of rhetorical questions on the bottom again. They're not completely rhetorical, but so when should you use wholesale funds? So if we believe, and I think most of you probably do, that most members see the most value from the loans that we make or say more value from the loans that we make them than they do from the interest that they earn on deposits, then we should be funding those loans with wholesale deposits or wholesale funds when it doesn't match, when we don't have the growth in deposits to meet the demand for the loans. So that's a good guide for you. Is it they're never going to balance, right? So the inflows of deposits are never going to balance with the outflows of loans. So it's a delicate balance. You need to use all these things, and technology is a big piece of it. Expanding the branch network, all those things. And when should we use excess liquidity? So excess liquidity, I think the regulators would say there is never such a case as excess liquidity. But if you have excess liquidity, meaning you have assets sitting in lower earning instruments like cash or even the Fed is not a bad investment these days, although that rate's going to drop. But if you have excess liquidity, it means you're probably not getting the loan demand that you would really like, or you're paying too much on deposits, so you're getting more funds coming in than you can use. So,
if I
questions?
can share a story, Tim, before we move on,
Oh, sure.
about
Yeah, absolutely.
to emphasize, what Tim's point about the brand management and sort of the understanding your niche. McKinsey and Company did a great article this summer on 6 strategies on how to reach millennials and Gen Zs. And one of them is what Tim's saying here, is around your brand marketing and to identify a value system that is shared by the clientele you're trying to attract. And one of the clients we have is based in Colorado, and they've developed a very effective brand around alternative energies. And so their branding, their messaging, their imagery is appealing to a certain group of people, tending to be sort of the younger credit union members who
Right.
also share that same value. And so it's just an example of, what Tim was sort of saying about the importance of that, regardless of what the rates they're paying.
Yeah, absolutely. And they have no branches, right? So they're a completely online institution. And all they do is make clean energy loans. So basically you have this concept of green deposits and green loans. And there's a lot of individuals that like that idea and want, the money that they invest, whether it's deposit or security, to go into things that are going to, help us in call it the energy conversion, right? Or transition over the next, several decades. So yeah, and they are a great example, and they're actually doing quite well. You can make deposits here. Obviously, that they're a national institution, those federally chartered multi-common bond field of membership, so they can make loans and take deposits anywhere in the country. Yeah, it's a great brand, but they're not unique. I mean, there's others that are doing similar things. In even some of our friends in the banking world are doing some of those same things. Let's go ahead and move forward. I don't want to spend too much time on funding growth. But I do want to mention a couple other, kind of, led into this, a couple other innovative business models. I don't know if you guys are familiar with, Alliant. We're the larger institutions that, again, done a great job of branding and building technology without branches, even though they started as an institution as a employee credit union for United Airlines. So they actually had little tiny branches in airports around the country, actually around the world. They had, credit union offices. They don't have any of those now, and they've grown, like you wouldn't believe. I mean, they've doubled a number of times over the last, 3 or 4 years, and they're about a $20 billion bank now. It's a great story. It's all those things that were on the list. It wasn't about rate. I mean, although they do pay some decent rates, but that's not the primary lead on a lot of these things. And with lower cost, without any branches, it allows them to do things a little differently. I've got a couple other things on a neobank. An example of a neobank is kind of like clean energy. They don't have any branches. Alliant used to have branches. They don't anymore. But there's de novos. Clean energy, the Colorado institution was de novo, kind of a neobank. But the BAS with fintechs is, banking as a service is where a credit union or a bank will team with one of these fintechs like Chime. They're the biggest one out there these days, to do the back office work for the deposits, or even the loan servicing. So that's how those organizations work. They create a brand online. Those fintechs create a brand online, bring some technology, and it attracts a lot of eyes, and the servicers that are servicing it could be, your credit union. You never know. So that's some of the other things that are innovative business models that are really changing the way banks and credit unions, especially smaller institutions, need to think about their business model. You don't have to do these things, but you need to understand what's going on with some of these to compete properly. All right, let's go to the next slide. So this, kind of the second issue of, challenge that we're going to focus on. We only have three. We don't have all day. We only have three. Is preparing for rapid change, and this is really, in my mind, about the planning process. Lord knows, go back to 2020, 2021, 22, etc. Rapid change was the order of the day. We may have thought that we had seen everything before. We had not. Things that happened during that period we'll never forget. But I promise that there's probably more change coming that's going to be pretty quick. It may not be as dramatic as that, but there's going to be more change coming. So the purpose of planning, when we talk about the planning process, I've got my ideas about the purpose of planning. There are many different, these are not the only ones. But first, certainly we have to look forward to see what resources we have, and that we allocate them to the most important, strategies so that we can execute properly. Part of the process is, to look at all the alternatives. Doing a plan, we can't just say, okay, well, this is high, medium, low. We need to think of all the things that are impacting to run different scenarios to make sure that we are prepared, again, preparing for rapid change when things do change, because we know they're going to change. We know they're going to change. The planning process will end up every time with a budget that gets approved by the board, unless you're a lucky one that the board doesn't approve the budget, but I can't imagine that. So it's as soon as it's approved, it's wrong, because things are going to change, and you're going to be above it or you're going to be below it. So what you want to be able to do through this planning process is to identify what things can go wrong, whether it's things that are internal in your organization where you planned a new product, but we're not going to roll it out in January. We're going to end up rolling it out in July or September, or even next year. So that changes, your assumptions in your plan, and you need to react to that. So you need to think about some of those changes when you're creating your scenarios. So you before things happen what needs to change, or how you're going to react, so that you can maintain a steady increase in profitability. And that's what high performing organizations do, is they are nimble enough that they have and that's, the planning process helps, but you need to be able to manage it, understand, the benchmarks that you've set to identify, I call them triggers, when something's happened that we've already talked about and we're ready to make that change, right? So that's to me the purpose of planning. Another purpose, I guess the last one there, to me, is important. CFOs don't get a lot of opportunities to inspire their team, but if you involve everybody in the plan and everybody has an input, and it not only makes them more focused on the different scenarios and how they impact that, or how they have a positive impact on the total plan, but it focuses them on execution. And that, along with a good longer term strategy, really can inspire the team to do a better job on performance. So that's my idea of the purpose of planning. Not sure if yours does that or not, but think about it. Think about it. It's not that hard to do. There's plenty of tools out there to do it. You can even do it in a spreadsheet. One of the things you do want to do as I continue through the process is start early. And early is relative. If you're starting now for your plan for 2025, you're probably late, but you probably started a month ago. So, yeah, the key though to me is to get to a base case pretty quickly. Okay, one that you're comfortable with, that is not the, the dream year, or it's not a worst case. It's just a base case where I try to use current rates for all of that and not put any rate forecast in it. And then you start doing scenario analysis on top of that base case. Okay. And as you start, when you start getting better at this, and you get not just 1 year, but you get 2 years or maybe even 3 years of a plan, and you understand all the triggers over that 3-year period, then you can get into kind of what I'll call a best practice, is where you have a continuous planning process. And that means you update your plan, probably on a quarterly basis, maybe a semi-annual basis, or when some significant impact happens, so that you can forecast from where you're at in the year, how I'm going to end up by year end, right? And that'll allow you to manage your performance better. That's what high-performing institutions do. And they do it well. So the last item, challenge, okay, is, well, I'll say it this way. So I said capital is king up top, right? The only thing more important than capital in financial institutions is people. And because, if you look at the expense of every financial institution, people is at least 60, maybe sometimes 70% of operating costs. So when you include benefits and everything around that, facilities, et cetera. So getting those folks, working effectively on an ongoing basis, providing a path for them to develop, a path for them to continue to learn and grow and have an impact is one of the keys to being able to retain people. Of course, we've all been through this at one time or another. We've trained somebody, they've done a great job, they've become very good at what they do, and somebody steals them away from us, whether it's another credit union or bank or somebody else, and we've just trained somebody to go work for somebody else. So that's a reality of and I call it, it's been a difficult environment for that for a long time. It's not just since the pandemic, but things have changed significantly since the pandemic. And it's, we all know that hybrid is reality. We're on a webinar now. Maybe someday we'll meet together again in a physical place to have these kind of conversations. But that's reality. And it's an opportunity also, as I think we can all agree. There are things that the organization the credit union I was with during the pandemic, things that we did then that still amaze me today. And the speed that it was done was pretty amazing also. We didn't make all the right answers. We didn't make, often the key is to ask the right questions, because, given the right answers maybe is always easier than asking the right questions. But anyway, retention and development is, it leads to a lot of times these, what Martha talked about early on, where, our CFO, goes into situations where there's, we'll call it chaos. And chaos may mean, well, we just lost our controller and we don't have anybody that knows how to do the call report, so we need to do it next week. I mean, that's not big chaos, but you may lose the CFO. There may be changes that are coming up, conversions that cause big problems. And we've recently had an institution that went through a serious issues with the conversion that we helped them out with. And but this is important. This is a very important probably maybe the most difficult challenge, I think, today, particularly in smaller institutions, because you don't have the resources to train people yourself often. I mean, CCUA does a great job with this. There's other organizations that do a great job with training. But those aren't free. But a lot of times the best training is the on-the-job training. And where you in a small organization where you wear more than one hat, you get cross training, and it becomes important. And it also becomes a way to develop people. So in some ways, it's easier in small institutions to to get that cross training and to provide a path. But they're the ones that you often see somebody going on to another organization that's larger. So let's go on to the next slide. So I talked about some of these things already, but the key to me here is, how much expertise do we need in our organization? Because every organization is different. Everybody's got their own story. There's thousands of us across the country. Our members are still with us because they love our story and they love our location and our people. So how much expertise do you need is dependent upon your business model, on how you serve your members. But there are other things that are impacting that other than just member service. Additional compliance, right? New accounting regulations. Everybody loves, CECL. The FASB is not going to stop bringing on, new accounting regulations. We don't have to deal with the IRS much, but the level of expertise is with the change in technology is requiring a number of things, and we want to be able to manage our balance sheets better, and it's difficult to get the expertise to do that in smaller organizations. We want to be able to evaluate alternatives and plan better. So all those types of things are things that the resources in smaller institutions are not the same as resources in institutions that have bigger budgets. So, and when do we need it? We don't need it all the time, right? For smaller organizations, we don't need it all the time. We need it on demand, basically. So that's where, sharing services, whether it's, in a QSO or some other type of organization across multiple credit unions, is a something that I think is going to make a difference in credit unions in the years to come. I mean, credit unions already collaborate a lot, and that's one of the beautiful things about credit unions. But credit union market share overall has not grown for a long time. In certain products, it has, but when you look at the total overall share of the financial services market for credit unions, share hasn't changed. We need to do something about that, and part of it, I think, is going to be more collaboration. I don't think we can. There's no way for us to do too much collaboration, and we just need to figure out the right ways to do it. So, some final thoughts. I talked about the need for expertise internally. I talked about resources to develop it. But what should our team be focused on first and foremost? So this comes down to, when we sit down with our board each year and we talk about, the future and our plan for the future, what do we have? What is on the top of the list? Is it adding a new branch? Is it bringing in new technology? All those things add to the complexity lots of times and impact the top two things, right? They impact our need for internal expertise and how we acquire it. And the more that we share those costs across organizations, across credit unions, the better off we're going to be. So just thinking about, the organizations that are on the call today, do you feel like you have the resources, all the resources you need? Do you feel like you have enough to share? If you have open positions out there right now, are those open positions things that you've thought about outsourcing, or at least some piece of it? That's the kind of conversation, or the things that I believe will help you get to some good answers on resources, on the planning process, and on dare I say, the existence of credit unions into the future. And believe me, I think we got a long way to go in credit unions. Credit unions, if I can help in any way for credit unions to increase their market share and to get what they deserve, of the market share because of who they are and why they do things, I would like to be able to do that. Questions?
Thank you so much, Tim. If you have any questions, please go ahead and put those in the chat. We'll give you guys a few minutes to do that. All right, chat is clear of questions, nothing in here. Thank you so much, guys. I really appreciate your time today, and this was a really great presentation. Thank you so much, Martha.
Thank you.
Thank you.
Thank you, CCUA. Bye-bye.